The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as you look across Tuesday's market action, another down day in the wheat complex. Quartered soybeans did their best to find a little bit of support into the close. A mixed bag in the livestock sector as well. Fairly quiet outside markets, too. Let's take a look at what's happening and talk about things. Joining us for a conversation, Jim McCormick with agmarket.net. Jim, it's good to hear from you again, my friend. How are you?
Hey, good afternoon, Jesse. Thanks for having me on. I'm glad to be on.
Well, let's talk about this grain trade from Tuesday's session. I mentioned corn, beans had a little bit of support, but all in all, these markets have kind of been trading pretty quiet here as of late, Jim.
It's been very, very quiet. Like you said, the corn and beans found a little bit of support today. The wheat market was under pressure. The wheat market's had a pretty good rally recently. We're now taking some of that off. The crop ratings improved overall. And I think that's kind of leading a little bit of liquidation in the wheat. But yes, mostly the problem is, Jesse, there's nothing out there to really get this market excited. On the weather front, a lot of the traders are waiting to see if these longer range models that have been essentially since early winter projecting as we moved into June, July, August, the atmosphere would turn hotter and drier, especially in the Western Corn Belt. And right now, that just is not being seen. So we don't have a weather play at the moment to get the market excited. We do have a June WASDE report out here on Thursday. That probably is going to be relatively a dud on the beans and the wheat complex. The corn market could be the wild card, Jesse. There's a lot, exports have been phenomenal. The question just is, how aggressive is the government going to be on raising that export number? Are they going to be conservative and raise it maybe 25 million, or could they be aggressive like some people believe and raise it as much as 100 million? If they would go big and raise it like 100 million, that may be that bullish news that maybe the market is looking for to try to nudge these funds out of this big short position they've been building in the corn market.
Well, and that's the thing. Funds have gone short in corn, and I'm curious, without a weather scare, how concerned are you with this corn market at, this 430, 440 level here? I mean, we're getting dangerously close to some support levels here in these corn, Jim.
Well, I think it is a concern if you're a producer unsold. I mean, if you're an end user, I suppose you're kind of happy the prices continue to go lower. But the reality is, we've got a very tight old crop ending stock. Right now, it's over 1.4. The average guess says it's going to drop below 1.4. But the market just has not been performing like that. Carry out is sub 1.4 potentially. Does that mean that demand is not as good as they think? Maybe the feed number's off? Or was last year's crop actually understated and it's bigger than what it is? Whatever it is, right now, you could argue the market just doesn't care. Maybe it's the fact that the Brazilian crop is so big. They're saying, hey, we've got enough to feed the world. It's a world market, and it's all going to be up to the U.S. market. And right now, the weather looks good. But it is a concern in the overall picture because look at it. You've got, July corn trading down here, making new lows or right down near the contract lows. And we're talking about a 1.43 carryout. These corn's pretty much trading the same price with a 1.8 carryout. So, this carryout number would argue maybe it gets a little bit lower, but even then, is it really going to get this corn market to rally like we all want? The biggest fear I have, is that the yields are there and the demand's not there into 2025. Because the government, when they did this balance sheet, Jesse, they went big on the yield, which they do, trendline yield, and then they use that planted acres numbers, from the survey. They offset that with a huge jump in demand. Ended up with a 1.8 carryout. If that demand is not as good as they think it is, due to the economic slowing down, maybe the trade deals don't come to fruition, and we start talking to carryout back toward 2 billion for some reason. Last fall, we're in late August, early September, we bottomed this market out right around 365 on the September contract when the market was trading a little over 2 billion bushel crop. So yes, I believe if this crop gets, we have some weather premium left in the market, and if it continues to get confirmation that carryout's 1.8, ballooning closer to 2 billion into the fall potentially, you're probably going to see prices lower. So there still is some downward risk, but I'm optimistic, at least temporarily, we hopefully can get somewhat of a dead cat bounce.
Well, Jim, thinking about this grain trade, corn, soybeans, et cetera, everything's just felt like it's kind of chopping around. And I know the mood, not a lot of producers are really excited about marketing at these levels as we kind of wait to see if this weather story plays out and really just early part of the growing season. It just feels like everything surrounding the grain markets is really quiet right now, Jim.
It is. And, and if you're a producer, it kind of makes sense, Jesse. If you think about it, a lot of the producers bought 85% crop insurance. Okay. Now that is APH, and usually you produce better than APH. So even if you bought an 85% crop insurance, you're still pretty much have insurance on maybe somewhere between 70 and 75% of your 75% of your actual production. And that insurance on the corn's at 470. So there's just not a lot of enthusiasm to sell corn at these current price levels. And I understand that. I do think there's a shot we could get a rally. It's kind of interesting where we're at. The CFTC report last week showed the funds carrying a pretty hefty short position for this time of year, but it's not unprecedented. In recent history, there's been 4 years where we've seen the fund position actually bigger than it is now in the corn market. And in 3 of those 4 years, we did have a rally. In 2015, we rallied about 90 cents in a little above, 16 days. In 2017, we rallied about 41 cents in 8 days. In 2020, we rallied about 41 cents in 3 days. And that was just a little bit of a short covering rally by the funds. Now, you can't get too bulled up on that, Jesse, because all 3 of those years, eventually we did go down and take out the June low that they bounced from. And 2 of those 3 years, you continued to sell off all the way into the fall. 1 year, you did reverse. So there is a history to see these funds essentially rotate out of the position, at least temporarily. We've just got to take advantage of it. It's not a guarantee. In 2024, last year, the funds were short of quite a bit of corn this time of year, and they didn't even try to dislodge out of that short until we got until the latter part of July. But, there is a little bit of numbers out there, and we'll see. With this WASDE report coming out there, the weather's a little bit interesting. The midday model took some of the rain out of the forecast that was in for Iowa earlier this morning. The longer range maps are trying to bring some real heat into the Western Corn Belt. Is that what could be enough to break them out of this doldrums? Hopefully so.
It just seems like seasonals, everything, so much uncertainty in these markets. We're not even getting into the headline risk that's out there. It just seems like this year we want to try and compare it to previous years, but it just seems like everything feels a little off in the trade right now, Jim.
Oh, I think 100%. I mean, you're trying to find analog years, like the point I was just pointing out. There's one thing, but like you said, we're in a situation, I think part of it, you got to be honest with yourself, that is a trade war that President Trump has started with all the nations of the earth. I mean, a lot of this market, not even the stock market, is a little bit frozen. The stock market sold off hard at the beginning of the trade war. We've pretty much erased back and kind of where we were before the trade war, but we're waiting to see what happens. We really don't have any trade deals on. They're meeting with the Chinese right now, and that's a pretty cutthroat negotiations right now. I don't think a lot of it's involved in ag. A lot of it has to do with rare earths, of them shipping to us, buying rare earths, and us shipping computer technology to them. I haven't seen any headlines about agriculture even being involved in this deal. So we need to see where it's at. And then you look at the bond market. That bond market sold off very hard a few weeks ago. It spooked a lot of people in the world. The stock market, as they say, Jesse, is not the economy. The stock market's a stock market. It's almost more of a casino. It's stock firms are buying back their own stocks, to try to manipulate it, But the bond market, that is how the world essentially is financed. If our bond market unravels due to this deficit or whatever it may be, it could really cause a lot of economic hardship. And, that's part of what you're saying. The market seems kind of a little bit froze at the wheel because after that scare a few weeks ago, we're really not sure where we're at. So there's just so much uncertainty right now. And that has really got us into very quiet trading ranges. I mean, it's pretty amazing when you look at some of the trading ranges we've seen for the month of June, just very, very quiet days.
We're talking with Jim McCormick from agmarket.net here today on Market Talk. And Jim, it's hard to speculate here, but barring weather or a headline risk, we keep waiting for these renewable volume obligations, things like that. It almost feels like these markets are going to need maybe something more than a weather story potentially here. Like it feels to me that it's going to need a couple different things to give it any sort of bullish momentum. Otherwise, we're just going to chop around and the mood is going to continue to be bearish is what it feels like to me, Jim.
I would agree with your assessment. Like I said, if you look historically, let me talk about the weather rally real quick. If you get a weather rally, traditionally it just doesn't last. I like to say weather rallies are like like a firework. They burn bright, they burn hot, and then they burn out quick. They just don't last. So if we do get a weather rally, it's probably a selling opportunity. What you're looking for is that long-term bull market like we've seen. And to get that, you've got to get either a true production loss, drought-like year, and that doesn't seem like it's going to happen. Otherwise, you've got to get some kind of demand situation above and beyond what the market's expecting. And right now, we're just not seeing it at this point in time. And the market, it seems like, if you look at the way the funds are voting, at least on the corn and wheat, they're carrying this massive short position. So if you view the fund's position as a vote, they're voting that this market's going down, not up.
Let's talk about the wheat trade again. That was a big loser on the day Tuesday, and it's a couple sessions in a row now that have been lower after a pretty substantial rally. So one has to wonder, is this just a bit of profit taking after we brought the wheat market back a little bit, Jim?
I think it's a little bit of profit taking. I think it's a little bit of risk off. I think some of the money rallying into last week. I mean, I think there's some money coming into the wheat market, even into the corn market to a little bit of extent after the Ukrainians went after and really took out a lot of those Russian bombers and essentially did billions upon billions of damage into Russia. I think there was a fear going into this past weekend, Jesse, that Putin would go after infrastructure and really go after maybe the Odessa port and shut down that port. And when that did not happen, and I think that might have had to do with the Chinese saying, don't do that. You do that, you're just going to drive the price of food up for not just the Ukrainians, but the rest of the world. You're taking some of that premium coming off. And then on top of it, we just got to face it. We're moving into wheat harvest. It is starting down in the south. It's going to start moving north. And just traditionally, it's very hard to get the wheat market to rally in the midst of harvest.
Well, we're tracking all these things in the grains. How about over in the livestock sector, Jim? Let's talk about that. Cattle, here we are, this cattle market that just a market that won't go down, just doesn't want to seem to go down. It can't go down, it seems. I mean, what's your assessment as you look over at this cattle complex right now, Jim?
Pretty amazing. June cattle right now, its goal is to merge with cash, wherever that cash may be as we get to the end of the month, that as we're in delivery. So June is going to go match cash. The back months, we'll see what happens. And that's where we're at. It is pretty much plain and simple. The story we've been saying forever, Jesse, the supply is just desperately tight. And the goal of the market right now is to get prices high enough to essentially ration demand. Now, if I'm a producer out there, I'm going to encourage you to start laying off some risk. I do think we are starting to see some cracks in the demand side of the equation. I saw a stat, somewhere between 75 to 80% of all Americans, unfortunately, are living paycheck to paycheck. Okay, that's where they're at. These tariffs remember, at a minimum, everything coming in the United States is at a minimum a 10% tariff. If it's coming in from China, it's at least a 30% tariff. Those prices are getting passed on to the consumer. And when you already got a consumer that's stretched, already living paycheck to paycheck, even a 10% tariff and an increase in that product getting passed along to you is going to hurt your bottom line. The second thing, keep an eye on what's going on, is the student loans. They now have to be repaid after being frozen by the Trump administration in the first term, kept froze throughout the Biden administration. Those are now off. It is estimated by JP Morgan, Jesse, that is going to cost, at a low end, it'll take $3 billion out of the economy per month. The high end, $8 billion. So that's money that was maybe normally going out to eat, maybe buying that steak. It cannot go to that route. It has got to go to the government to pay off the loan. That consumer essentially does not have the disposable income he had, and that's going to be damaging. Then just lastly, what I like to look at is what's going on in the advertising sector. What's interesting is you're driving around, because we see you're in your mobile studio today. If you drive by McDonald's, if you look on what's the sign, what is McDonald's promoting? They're not promoting the Big Mac. They're not promoting the Quarter Pounder. They're promoting what? Chicken.
Mm-hmm.
Chicken, as essentially the cheaper protein. What's even more amazing is watching the NBA Finals here. They were showing that Taco Bell is advertising chicken as well. I've never thought I'd ever see Taco Bell advertise chicken nuggets, but there they were. And I think that shows you, as you're going into the retail sector, the food sector, they are essentially trying to market to lower cost proteins to people. And I think that is a red flag to the cattle market. So, we'll see. Like I said, the market's goal is, like I'm going to reiterate, is to essentially ration demand. And how do you do it? You take prices over and above where it needs to go, and then it eventually, in the cattle market, it collapses hard. And with these wider trading ranges that CME Group has put into play, when it does get ugly, when it does roll over, and cattle traditionally roll over quickly and violently, it's going to get nasty, I fear.
And I have contended this for a long time, Jim. When consumer demand finally hits that brick wall, and people, even if they want beef, they just say, I can't afford it. I have to get pork. I have to get chicken, lamb, whatever. The trade down. Whenever that happens, by and large and fully, that's, I think, going to be the point where these cattle prices hit their top and have to come down. And we've seen this on the meat demand monitor that Glenn Tonsor does at Kansas State University. Retail has started to slip, and now at home is starting to slip a little bit. So, like you mentioned, maybe some of those signs are out there, but I've said this for a long time. When that brick wall finally hits and the consumer says, I can't buy beef even if I want to, I feel like that's going to be the tipping point, Jim.
Yeah, I agree. I mean, and it may come, trying to pick the top is a fool's errand. I'm going to stress it, folks. We have Father's Day weekend this weekend. That tends to be a big grilling weekend. And then within a couple weeks after that, we have the 4th of July. Well, it'll be interesting, Jesse, when you're out there having that 4th of July party and people out there, keep an eye on, you start hearing people talk about the price of food and the price of meat and how expensive it is, and see what people are grilling. Are they grilling hamburger? Are they grilling pork? Are they grilling chicken? Those are the signs we're looking for. And I think, it's not going to be historically, it's not one of those situations where it's a 45-degree up, 45-degree down. It tends to be, the old axiom is, it's an escalator up and it's an elevator shaft down. And like a fund position, as massive it is, folks, wow, if they decide to ring the bell, as I put it, it could get violent really quick. And you can, see this market, because you're essentially going to overshoot from the top and then traditionally overshoot to the bottom side.
So let's talk risk management here, just to kind of close things out. And I know for, cattle guys and gals, I mean, they're loving price action. They're managing their margins as best they can, managing the risk, maybe a little nervous at these levels. On the flip side, you got grain producers who not really thrilled with prices, kind of down in the dumps a little bit, and don't want to do a lot of risk management here, I would think. And that's kind of the feeling and sentiment I'm hearing. So it's, I'm sure, a couple different ways to look at it, different conversations depending on what you're doing. But from a risk management standpoint, as we get into the summer dog days, I mean, what do folks need to be thinking about, Jim?
I think what you really need to do, they need to reevaluate where you are at and where your cost break-evens are. Right now in the cattle sector, you're probably making money. You want to make sure that is there down the line. Now's the time to make sure you are profitable and do what it takes, be it crop insurance or the LPR insurance potentially, or puts, or just forward contracting. You want to lock that profit in while you can. As we mentioned, the uncertainty is just so high. It's unprecedented, I would say, the economic uncertainty where we're at. And there's ways to, options will give you a floor, but leave the ceiling in. Crop insurance or the LPR insurance for the cattle does the same. On the grains right now, Jesse, no one's really excited about selling corn and beans right now. Let's face it, if you sell it now, you're locking in a losing trade type of situation. But what you need to think about now is, where are your break evens? Where are you willing to sell the grain now? And I'm encouraging people to, two things. You might consider buying some options now and then use that as leverage to sell some cash or futures against if you want to, or at least have an idea where you want to get that orders to sell if you would get an opportunity to get a short-lived rally and be profitable. Because the one thing about these summer rallies, folks, it's going to be very, very emotional. And it's probably going to put the top in, and maybe in at 3 o'clock in the morning some morning. So if you can make money at 470, that was essentially right there where the crop insurance high. There's a lot of stats saying that you'd hit that. And then you got another resistance right around, I think the Feb high was right around 480. Don't be afraid to put those orders in and get them working with your cash sell or your broker, wherever it is. Because essentially history would say, like I said, when these do get weather rallies, they tend to be fast, they tend to be furious, and they tend to be short-lived.
It's a good point to wrap up on. Jim, I know if folks want to reach out, have a conversation, take a look at managing their risk and balance of the books and more, and looking at the break evens and everything else. You guys have a great team and a lot of resources available there at agmarket.net, don't you?
We do. You can reach me directly at 815-665-0461, 815-665-0461, or go to agmarket.net, download a free trial of our app, which does help you market grain.
Jim McCormick, agmarket.net. Always good to hear from you, my friend. Thanks for joining us today on Market Talk. Have a good one. We'll talk to you again real soon.
Thanks for having me on, and happy Father's Day.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.